mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Good to be back for another episode. It feels like it's been a while since we've just carved out some time to just chat. It feels
Doesn't we chat twice a week?
It's been a very busy few months here at Equity Mates, and
Crazy.
There's a lot of exciting stuff happening. You've set the target of interviewing every CEO in Australia.
Well, we wouldn't go that far, but yes, all 200 of the top 200.
Yeah, and obviously a lot happening with the book and all of that. But in this episode, I think it's worth us just taking a breath, pausing for a moment, and catching up on things we've been reading, stocks we've been watching. But then the content train rolls on, and we're going to be joined by Speccy Magee. And
Yes.
then we're launching a new show, and we're going to be joined by the hosts of Talk Money to Me.
Absolutely. As always, a lot going on at Equity Mates. Talk Money to Me launched last Friday. So looking forward to introducing you all to Candice and Felicity, two financial advisor experts who are hosting that show.
Yeah, it's a great show. The first 3 episodes are now live. And in this episode, Candice and Felicity have both brought a stock that's on their watch list or on their order pad that they're going to be talking through. So stick around to hear 2 stocks that our latest hosts, both financial advisors, are looking at the moment.
And who doesn't love a stock pick? I love stock picks.
You love hot tip. You were telling me that the only reason you want pubs to reopen is so you can get a hot tip from a mate at the pub.
No, it's so I can throw out hot tips then. All right, Ren, well, let's kick off. Bit of a catch-up between you and I, what we've been watching, reading, buying. It's just going to be short and sharp, but it's just a nice way. I don't think we've caught up on this level before because of everything that's going on. So what have you been doing?
Yeah, well, with lockdowns, and we hope everyone is going okay with lockdowns. I mean, the faint silver lining is when I can slack off and pretend that I'm working and tell you that I'm working.
When does that happen?
It gives us a lot more time to, I guess, consume content and look at stocks and invest. So there's been a lot happening. I think let's start with what we've been reading. So I've read 2 books recently that I want to add to, I guess, your reading list. And
Yeah.
we should also give a shout out here that if people may not have noticed, we've updated our website and we're now pulling out all book recommendations and putting them on the website. So people can jump over there if they want to see books that have been recommended by experts. But 2 books. First one, The Hard Thing About Hard Things by Ben Horowitz.
Yeah.
Have you read it?
No, but you have been harping on about it for a long time, and I feel like if I don't read it soon, I'm going to be in a lot of trouble. So I'm definitely going to get that on the watch list.
Really interesting book. So Ben Horowitz, now one half of the superstar venture capital firm Andreessen Horowitz, but the book, it really centers around his time pre-VC when he was leading a couple of different companies, and really it was in sort of the early days of, well, not the early days of Silicon Valley, but the late 90s and early 2000s. And it's just a fascinating read for a number of reasons. But the thing that really stands out to me is they were trying to commercialize cloud computing and basically make cloud computing a thing. And obviously we look at it today and we're like, well, cloud computing is everywhere. Amazon and Google and Microsoft are all, making so much money from cloud computing. But these guys were too early. And as I read it and, read how the business struggled and didn't really succeed, it was just such a stark reminder to me that a lot of these themes that we're talking about today, There was the medical marijuana boom. There was the lithium boom. Although that one is still going. There was the gambling boom where it looked like America was slowly creeping towards legalization. Like all of these stock market booms happen because it's like there's a trend that makes sense, but you can be too early and companies can be too early. And reading this just was like really stark how the best operators with great ideas can just be at the wrong time.
Yeah, unfortunately, sometimes timing is everything. And unlike trying to time the market when it comes to getting businesses off the ground and or getting big ideas that are innovative and transformational off the ground, you're right, you could have it. But if you can't execute it at the right time, then someone else might get it a bit further down the track.
Yeah. The other book that I've been reading, I think this was recommended to us by, I can't remember the expert. This is where the new website would really come in handy. I could just look it up, but I don't have it in front of me. So I'm not going to try and guess who it was, but it's Cokeland. You've probably heard of the Koch brothers.
Yep.
Charles and David Koch. And they, I guess, are famous for funding right-wing politicians and for basically astroturfing US politics and creating like fake grassroots organizations to like push their political agendas. And that's all I really knew about them, and I didn't really want to know anything more about them. But when it was recommended to us, I was like, oh, I'll give this a go. It sounds interesting. And it's fascinating. It's fascinating to read how it was more Charles than David, but how they built this business and how they made all their money. And this business is just in everything. Like they basically just found industries that people didn't think about, or there weren't any big players, or the big players weren't known, but were just critical to global supply chains, and they just dominated these markets. It was, and I imagine still is, the largest privately held company in America, and it's a fascinating business story. You have to put the ethics of how they spent their money to one side.
Did they mention at all why they didn't ever go public?
They didn't want like public control. Like Charles, it was actually like it's really interesting. Like, so there were three brothers, and one of the brothers sued the other two brothers and then did this whole like smear campaign in public, and it dragged on for years and years and years because, basically one of the brothers wanted them to go public or wanted more money out of them, and all these investment bankers tried to get them to go public, but Charles was just like, no, not having it. But really, the big takeaway for me for that book, amongst a number of really interesting stories, was you often hear about like the financialization of the US economy, especially, and how like everything really ended up in financial markets, and like so much wealth, so much knowledge, so much talent, and so much of the economy eventually got centered around financial markets. And this story that starts in like the 50s and the 60s and goes all the way to the present day, it really follows that arc, and it really shows just like how much money got centered away from like the real economy that was making goods and services, and instead got centered around financial markets where, you make money, I guess, like trading rather than creating. Just a fascinating business story. So another one that I'd highly recommend.
So that was Cokeland.
Yeah.
Koch. Yeah, Cokeland. All right, Ren. Well, I'll add both of those to my list because you have been talking about them for a while. So I'll make sure I check them out. They should be on our website if people are interested, but if not, we can add them in there because now we've got a new website. We can do it.
And we've got to use it now.
And we've got to use it. Yeah. Nice.
What about you? Anything you've been reading?
I've been reading a lot of fiction. I find that it's a good way for me to unwind at the end of the day. So whilst I have a fair few books on order, also based on your recommendations on Amazon that are delayed because of what's going on in supply chains at the moment. But we've been fortunate enough to have been sent the Buy Now, Pay Later book by our mate over at the AFR, Jonathan Shapiro. So obviously being a shareholder of APT Afterpay, I've enjoyed reading that. So,
bro, you were a shareholder before it was APT.
True, yeah.
Do you remember
But
what it was before that?
No, I should.
Yeah.
No, Afterpay Touch. Maybe it was just APY.
Yeah, that sounds right. Yeah.
APY, yeah, and then it went to APT, Afterpay Touch. But anyway, it's an interesting read. I think the one thing I'm really enjoying about it is getting a bit of a history of Australian markets and business as well. You know, it's not just about Afterpay. You get a real sense of what it's been like over the last sort of 10 years or so, and I'm really enjoying that. But outside of reading, I've actually been looking at an ETF, and I feel like you'd have some insight on this, so I'd be great to get your opinion. But one of our mates has been talking about an ETF called Crane Shares Global Carbon ETF, KRBN. And as we say on the show, nothing wrong with taking a stock tip or having a look, but you must do research but you must do research yourself. And so I've spent the last couple of weeks actually digging into this a bit, and I'm trying to understand the bigger picture. And so I guess at a high level, this ETF tracks the carbon price through carbon credit future contracts, which then leads to a conversation around, well, how do we think the carbon price is going to act and perform over the next, 10, 20 years? Because it's obviously playing a pretty important part in the decarbonisation of the world at the moment. And we know that there are a lot of companies now saying that they're going to be going to net zero emissions, and governments committing to net zero as well by sort of 2030 onwards. And for me, this seems like a good way of investing in that change.
Yeah, it also makes a lot of sense for you because investing in the price of carbon is a good way to hedge the risk in your fossil fuel heavy portfolio.
That is just not true. The second part to this conversation is that after having a few conversations around ESG of late, I did a portfolio review to see how carbon intensive my portfolio was. And I'm happy to report that I'm not all cigarettes, gambling, or oil and mining.
Okay.
No, but that aside, so this led to me trying to, understanding the role that carbon credits and the carbon price has to play when it comes to companies actually reaching these net emissions. And as I understand it, one way they can do it is by buying carbon credits. And that's how they get to the net. So essentially they say, we'll buy these credits and then still be able to offload X amount of carbon or whatever it is. But this then becomes a supply and demand play, with the supply of these credits less than the demand from these companies, and as such, the price of these credits is going to continue to rise. That's one way to kind of look at it. And that's a thesis, I guess, which is why I think this is an ETF that I'm pretty keen on. Yeah.
I mean, you have to look at the regulatory environments in each country because there are different ways that credits can be created. So in some countries, it may be that the government issues credits and there's like a fixed number of credits that can be traded, and if supply is fixed and demand increases, then yeah, sure, that logic makes sense. The other way that it could work, and the way that it works in Australia with certificates, is you create certificates and then other companies have to buy certificates. And so as more renewables come online, more certs are created. The rate at which companies are making these net zero emissions pledges, I would agree that demand is probably outstripping supply at the moment. But yeah, when I worked at Coles, we had to buy certs, and then if you want to go net zero, you have to buy even more, or you have to put a whole bunch of solar panels on roofs and enter into a whole bunch of power purchase agreements and build like large scale solar or wind. So yeah, it's a really interesting thesis. Not one that I've had a look at too closely, but it's a curious one. But I think you call out there around companies saying they're net zero and how they achieve that is worth highlighting. It's great. Like, don't get me wrong, it's great because if a company is going to buy carbon credits or certificates, then they're creating a market for those credits and they're incentivizing more renewable energy to come online to supply those credits. That's great. That's the market operating. But Telstra saying they're net zero, or, like all these companies saying they're net zero, that doesn't mean they're not emitting.
The net is the key word there.
It doesn't, but it doesn't even, and like everyone understands that, but it doesn't even mean that they're reducing their emissions, their gross emissions. It just means they're offsetting them.
They should be offset zero.
That's really? That's why when you see a company say they're going net zero, also see if they're actually reducing their emissions as well. And Telstra, to their credit, have come out and said, we are net zero and we're continuing to put all these projects in place to reduce our total emissions as well. So yeah, that is an interesting one. I think you can do the maths, and like if you buy like the cheapest, worst credits globally, it's really not that expensive for most companies to go net zero.
Interesting. Well, there you go.
If you buy credits like certs in Australia and stuff like that, it is more expensive. But yeah. Oh, and we did that episode on with Quarter, where we listened to the Australian earnings calls. Every CEO we listened to talked about sustainability.
It's everywhere now.
The Australian investing community is holding these companies accountable for it.
Well, this is one way in which I'm sort of dipping my toe into that marketplace, I guess, and I'll continue to do a bit of research on it. But so far, so good. I think I'm going to drip into it a little. So for those interested at home, KRBN is the ticker. It's listed on the New York Stock Exchange. Check it out.
Really interesting theme there, Bryce. Definitely one that is getting a lot more, I guess, airtime, or a lot more news focus. And I think it's going to be an interesting ETF to watch. So good one to bring to the table. Let's take a quick break to hear from our sponsors, and then we are joined by an Equity Mates favourite, someone who's been desperate to come back on the show. He says he's got big things for us. After this, we're going to be joined by Speccy Magee. So, Bryce, it's about that time, the time we've all been waiting for. Let's call the Speccy hotline.
Let's do it.
200,000 shares Blue Star at 19.5. Can you position it in one of your equity funds? Listen, Blue Horseshoe loves Blue Star Airlines.
Hello. You've reached the Speccy hotline.
Great to hear from you too, Speccy. We are looking forward to this one.
The number still works. It's been a while.
Yeah, I know. And given some of my recent performances, I'm struggling to pay the Optus bill, but I'm still keeping it alive. So, thanks for the call.
Well, you've been harping on for a while about coming back on the show with some big Speccy tips, and I know that the Equity Mates audience have also been peppering us knowing when Speccy's coming back on. So we're going to throw it over to you to give us the update on what's happening in the world of Speccies. Of course, this is not a buy, hold or sell recommendation, because we all know you do absolutely no due diligence. But we're going to throw it to you to let us know what's the latest in the world of Speccies.
Thanks, Bryce. So speaking of the lack of DD, I had a reflection recently that what I want to do, instead of doing the DD myself, I'm going to outsource it. So I've paid someone on Fiverr to give me a recommendation, which I'm going to pass on to you guys. Okay, so I'm going to play that audio for you. All right, so
nice. So you've done nothing here
to keep it interesting, because I got this done 2 months ago, and I've been asking you guys to get me on the show for 2 months, but you've been ignoring me. So I actually know what has happened to these two picks since then. So there's 2 picks. That's how time works. You can act, and yeah.
That's how time works.
So to keep it interesting, and for those playing at home, I'm going to play the 2 recommendations, and then you guys need to tell me whether you would buy one of them, which one, or both of them, or neither of them, based on the tip. Yeah. All right. All right. And you need to promise me you won't Google anything related to that. Okay, cool. All right.
No Googling.
Sure. Yeah.
Hello, everyone. This is Rick, and on behalf of Speccy Magee, I'd like to provide a quick analysis of one stock and one crypto. First, I am not a financial advisor, and this is not financial advice. Ticker symbol ITRM. why I am bullish. 1. Imminent FDA approval for their urinary tract infection or UTI drug. It's novel because it will be the most effective oral medication of this type of infection. 2. The CEO bought 322,000 shares of his own company stock 2 months ago, always a good sign, as well as the medical director who bought 256,000 shares at the same time, almost 2 months ago to the day. LinkedIn post by Anna Rangalova announcing a partnership to launch ITRM's drug Sulopinam. So with those indications, I think that FDA approval is imminent and the stock will go up from there. Second is a crypto symbol, CELR, for Seller Network. Why I'm bullish? 1, their product, Seabridge's mainnet, will be live by the end of next month. Their Layer 2 finance testnet should be concluded by the end of next month as well. And if no issues are found, that will also likely be ready to roll out. Number 2, one has to only look at what Polygon did with their Layer 2 scaling program to know what the potential is here. Trade safe and trade happy.
Okay, boys. So we've got two tips there. What'd you think of that?
2 outsourced tips.
Honestly, that analysis was better than I would have expected from Speccy Magee. I think we need to get this guy to be our new Speccy Magee.
he lost me at imminent approval. I was like, this is way too deep. Like, what are you talking about? All right. So you've got ITRM, the UTI drug company, and then you've got CELR, cryptocurrency called Seller. So, Bryce, do you like either of them, neither of them, or what are you thinking?
Look, I got totally lost on Seller, to be honest. CLR, kind of didn't catch what he was saying, but also too deep for me, I think. I can get my head around ITRM, the UTI drug, FDA approval impending. So TBC on whether or not that did get across the line. I'm assuming if it did, then it probably would have gone gangbusters. I like the fact that they had skin in the game from a management point of view. If I was to lean one way, it'd probably be that way. But I also know that crypto has bounced in the time over the last 2 months. So I'm just going to go YOLO and say I'll take both, hedge my bets.
Both. I like it. Okay, cool. All right. Before I reveal the results, Bren?
Well, in the interest of this game, I think I have to go different to Bryce. So I'm going to say they didn't get FDA approval and who the hell knows what's going on with crypto. So I'm going to say neither. I'm going to stay in cash.
Okay, interesting. All right. So Ren, assuming a return of 0 on the cash, you haven't made any, you haven't lost any.
Good maths.
And Bryce is up 12%. So interestingly, the cryptocurrency went up 95%. So this is 2 months ago. Yeah,
95.
2 months ago, right? So if I were to give those tips when I asked you to have me on the show, your listeners may be up 95%. Now...
No, because they're not buy, hold, or sell tips, and it's not even your tip. It's not even your tip.
There's a lot of shade being thrown about how he doesn't get on the show enough.
Okay, but perhaps even more interestingly, ITRM is down 67% since that tip.
I'm assuming they didn't get approval.
No FDA approval. Yeah.
No.
Well, you haven't even looked at it.
Well, what's more is...
Get the Fiverr guy back. Get him to give us an update.
No, if you actually Google the company, there is a class action against them for the executives making false and misleading statements.
Oh, no.
Yeah.
Jeez, that's not good.
Have you had a chat to your analyst about his picks?
So yeah, there's a class action against them, false and misleading statements. So I mean, I guess the listeners could join the class action too. I don't know.
So I guess to kind of close this out, then what is the key? What's the key takeaway here?
That he doesn't know.
Yeah, Bryce. Excellent question. I think you guys can read between the lines here. Don't go to Fiverr for Speccy recommendations.
Or go to Fiverr.
It's not bad. It's kind of impressive. 95%. So yeah, overall up 12% over 2 months. So yeah, thanks guys.
Well, let us know next time you go on Fiverr. Or how about next time you come back on, you bring another form of DD that doesn't involve Fiverr, but perhaps doesn't involve your level of DD either, but is another form of DD.
That's not bad. That's not bad.
Yeah,
I would like I would like you to do some street surveys, like some vox pops, and do some street level.
Okay. And where do I send the invoice?
All right. All righty, Specky. Well, we will have to leave it there, but thank you for coming on, sharing the tips. That was ITRM down 65% and CELR up 95%. Nice ones.
Thanks, guys. Keen to come back on soon. I've got to say, next time I'm on, big announcement.
Okay. I like that.
Oh, wow.
I like that.
Okay. All right. We'll see you in 2 months.
All right. Well, we'll chat soon, Specky.
All right. Thanks, guys.
Well, Ren, as always, it's very chaotic when we chat to Specky. Hard to get a bit of a grasp on what's actually going on in the world of Specky stocks, but that's just because I imagine it's a pretty crazy world out there.
I feel no more educated about the Specky side of the market than 10 minutes ago, but...
It's classic. But anyway, full credit to doing no DD on that. So, Ren, from absolutely no DD with Specky to a lot more DD and some actual thought and consideration when it comes to investment ideas and wealth building strategies. And that is coming from our two amazing hosts of our new show, Talk Money to Me, Candice and Felicity. So we're excited for this show. And here they are chatting about what to expect and two of their favorite stocks at the moment. So, Ren, as we said at the start of the show, we are super excited because we have launched a brand new show here at Equity Mates. Equity Mates continues to grow and give new voices to the finance and investing community. And Talk Money to Me with our amazing hosts, Felicity Thomas and Candice Burke, is now live, and we are super, super excited.
That's right. We, for years, have said we are not experts and we're not financial advisors. Finally, we have some experts here at Equity Mates.
Phew. Bringing some credibility to the party, but we have them with us on the show today to actually talk through what Talk Money to Me is all about, and then to give a bit of a taste as to what you can expect on the episodes with one of their formats, Autopad, which I'm really excited about, where they're essentially going to say great investment ideas. So they're not buy, hold, or sell. We'll touch on that in a second, but let's start at the top. Candice, are you able to introduce yourselves?
Yeah, definitely. Well, big bar straight away you've set here that we are the experts in the room. That makes me feel good. So as you said, I'm Candice Burke and I'm a senior investment advisor at Shaw & Partners. And I've been in the industry providing financial advice and investment advice for over 6 years now. I work closely with my work wife, Felicity Thomas, and essentially we deliver holistic financial and investment advice to all of our clients. We cover lots of different areas of advice, being investments, superannuation, insurance, estate planning, the list goes on and on. And essentially our role as advisors, we break it down by 3 key points. Firstly, we understand our clients' goals and objectives. Once we know those, we interpret their goals and objectives really into the right financial strategy, and then we just deliver the advice from there.
And so I'm the other part of this dynamic duo, Felicity Thomas. I'm a senior private wealth advisor at Shaw & Partners, and I've been providing holistic financial advice for over 9 years now. Makes me feel a little bit old. Now, people close to me would actually describe me as a problem solver. So there's usually not a problem that can't be solved, and I'm definitely a glass half full kind of girl. Now, along with everything Candice just mentioned, we are also big advocates for financial literacy, in particular financial literacy for women. So together we co-founded Her Financial Network at the end of 2020 to connect women, and men, but particularly women, to trusted advice professionals.
Now, as we said, you guys are experts and you've helped Australians of all income levels get on top of their finances and get ahead in their finances. But we want to learn from your experience in this episode, and I'm sure in future episodes as well. What are some of the most common mistakes you're seeing Australians making when it comes to their money?
I think that's a really interesting question because for me personally, what I guess frustrates me or might be an error that we commonly see is initial poor advice that they may have received in the past. So, for example, They might be in their peak earning period, like in their 30s to their 50s. And someone in the past has said, you should just, buy this investment property in your personal name or start investing in the markets in your personal name. But when you are thinking holistic and a broader approach, which is what Felicity and I do, that's not necessarily the best approach. Could we be thinking maybe we can invest in a company structure, a family trust? Can we somehow capitalize and utilize the superannuation environment, particularly if you're getting close to 60, 65, like that's the best vehicle, right? So I guess, when it comes to learning, and what we continually do on a day-to-day basis with our clients is just educate and broaden our clients' horizons on the different possibilities, right, of your financial landscape.
Yeah, I think it's also a really good question that you asked. Really, it's like, how long do we have? For me,
this is a brief one, Felicity.
We got 10 seconds. Go, Felicity.
For me, it's clients not seeking advice in general, right? So you're never too young or never too old to seek professional financial advice. Yes, you need to pay for good advice, but it actually usually pays for itself after a few years. As an advisor, we do value our time and expertise and we charge accordingly, but it's not a bad thing, right? It means you should be getting quality advice. If advice was free, do you really think that your advisor has spent the time, analysing your individual circumstances and giving you the very best advice? Another common mistake is not actually knowing where you're invested or understanding your own behavioural biases and how that can actually impact your investment decisions. You honestly don't want to know how many clients we had to convince not to sell their portfolios during the COVID crash of 2020. They're really big things.
Yeah, love to hear that was your approach as well. If you'd both turned around and said, we told our clients to sell, then I think we'd have to be having a conversation more broadly about the podcast. But you've both raised some really key points there and some that I'm already thinking about. And so I'm very much looking forward to hearing the content that you guys are going to be pushing out through this podcast. There's no doubt that you two have an amazing chemistry and have spent a lot of time working together in this space, and I think are going to provide a lot of value. So are you able to elaborate a bit more on the podcast specifically, and what was the idea behind this, and really what can we, I guess, expect over the next few months, years, decades with this podcast? Yeah, decades. Yeah, put it there.
Wowza. Yeah, well, like you kind of indicated, as you can tell, we love our jobs. We're super passionate. We love helping people, and I think I personally get a lot of satisfaction out of educating and empowering clients to find out different strategies, right? Like I mentioned earlier. So we just essentially wanted to share these insights, learnings and lessons with a wider audience, not just keep it to our clients. My close friends would say that in my past life, I must have been a doctor or nurse because I just love helping people. And I put it down to this. A financial advisor, like what we do for our clients, essentially has the same duty of care as a doctor in terms of their financial well-being. So we can really make a powerful impact or a negative impact if you get poor financial advice to a client. So we take the duty of care very seriously. So we set out 6 years ago when we started working together thinking, how can we grow the business? What else can we do rather than just provide financial advice to our clients? We talked about a book launch. I know you guys just went down that route. We always were talking about a podcast. This is the time that we live in these days is super exciting because you can really share your insights to the broader world.
Yeah, and I think another reason why we wanted to put this together is because there's a lot of wealth podcasts out there and a lot are available, but there's not a lot that I would listen to personally. We wanted to be that wealth podcast that took our insights to the next level and one that really dives a little bit deeper into financial concepts and strategies. Don't expect investing 101 from us or what a savings account is on our podcast. It's just not what we're about. We're assuming that our listeners have the knowledge and are ready to take things to the next level.
Yeah, that I'm particularly excited about that element. We've done a lot of investing content here at Equity Mates and some of the other podcasts we have at Equity Mates Media, but Your podcast is going to be a lot more holistic than that. It's going to talk about all aspects of wealth creation, and I'm excited to listen, but I'm also excited to steal all of your best ideas and implement them in my personal finances. But look, we are an investing show, so we are going to focus on, I guess, some of the investing related content that you guys will be creating in this little segment today. One type of episode that you'll be producing is called Orderpad, where you share stock ideas that you're talking about with your clients. Perhaps you're even buying for your clients. And you've each brought a stock that's on your order pad today to talk about. So we'd love to unpack them. Before we do, it's just important to stress that while you guys are licensed financial advisors, you're on a podcast and you're not aware of anyone's personal financial circumstances who are listening. So this is add it to your watch list, do your own research and consider it yourself. This is not a buy, hold or sell recommendation. But in saying that, we're excited to hear about these companies today. So Felicity, why don't we start with you? You've brought the company Family Zone, ASX ticker FZO. So can you tell us about the company and why it's on your order pad?
Yeah, definitely. So it's a 510 million market cap, which makes it a small cap. It can be found on the Australian Technology Index. Now, Family Zone Cybersecurity actually engages in the development of parental control platforms. It's created a single system that manages the majority of the parental control functions in a cloud-based application. Now, this singular approach enables schools, parents, cyber safety experts to collaborate to keep children safe anywhere, at any time, and on any device or network. Now, the company was actually founded by Tim Levy, Ben Trigger and Paul Robinson and Crispin Swan in 2014, and it's actually headquartered in Western Australia. So the reason that we like this company and we have been buying it for our clients since late last year, it's actually also one of Shaw's analyst top buys. We recently participated in the rights issue at 55 cents because we think this company is exactly in the right sector, being tech and the theme family cybersecurity. So it's got a lot going for it. I mean, I believe there is a $200 billion growth opportunity in cloud cybersecurity over the next 5 years. Now, you probably would have noticed this, but there's a global shift towards digital SaaS model businesses. And we saw that acceleration last year during COVID and now this year with the extended COVID lockdowns. Family Zone has the scalability, the ease of deployment, and the consumer relevance. So it's experienced high growth that, in my view, is proving to be sustainable into the future. I mean, online, children are likely to be exposed to adult content, cyberbullying, privacy issues, sleep disturbances, if their usage is not monitored and tailored for control. You know, FZO's control solutions were actually developed to address these issues, creating digital environments where children can thrive. I mean, last time I actually pitched Family Zone, I think it was on Ausbiz, and we also posted it on her financial network. It had 2.5% market share in the US. It's now got 7% of market share in the US, whilst building an international firewall. If you want to look at probably the financial metrics and a recent catalyst, Family Zone last month agreed to purchase Smoothwall, which is a UK-based provider of K-12 digital solutions for $142 million, which is why they recently raised $146 million. Now, on a combined basis, Family Zone business will now serve 9 million students, 18,000 schools, and have an annual reoccurring revenue run rate of around 44 million, which has essentially tripled its reoccurring revenue. Now, after the acquisition, Family Zone should have around 33 million left in cash, so for ongoing working capital, which is important. And then on a pro forma basis, the business will deliver an FY21 EBITDA loss of 12.7 million, being an assumed EBITDA loss of 19.7 million for Family Zone in FY21, less the 7 million in EBITDA from Smoothwall. But this should drop to the loss of 5.3 million for FY22, and then it actually should be EBITDA positive by FY23 with 12.1 million. So for me, the upside is actually really endless with this business, and it could be very meaningful if they reach 17.5% penetration in the US and UK. That would actually net an additional 92 million in annual reoccurring revenue by FY25, or an EBITDA positive of 36.5 million.
Love it.
Now, because we helped raise capital, Shaw is still restricted in providing an updated 12-month price target, and it's kind of already trading around that level, around 77 cents. However, Consensus price target for the Smoothwall acquisition is around $1.20 to $1.25, so I actually expect by the time this podcast is released, our price target would be similar. So, for your listeners, upside around these current levels is about 66%. That's it. It's good. It's a good company for long-term growth.
Nice, Felicity. Well, I love listening to that, and no doubt that certainly excites me for the rest of these Autopad episodes. However, there is still half of Talk Money to me to go. Candice, you have the floor. You're pitching a stock that we have spoken about on the show a couple of years ago from memory, Atomos, ticker AMS, but I'm sure you're going to come at this with a level of rigor that we perhaps didn't. So looking forward to hearing this on.
So the company today that I'm going to pitch is AMS, like you've mentioned. It's considered a small micro cap, right? Because it's only really 330 mil as a market cap right now. And it falls under, obviously, the tech sector of the ASX. I found this stock for the first time back in the beginning of the pandemic, all that time ago in March 2020, because I was actually quickly realizing, we can't go to the office. I've got to quickly get all my home office set up. And Atomos does exactly that, right? It's a video technology company which enhances video content creation, to help existing products like Zoom, Squadcast like we're on, all the digital media tools that we use in the pandemic world is really where Atomos plays in that space. So it designs, develops and commercializes the monitor recording products to ensure that content creators of all kind are constantly accessing the latest video monitoring technology out there. The company has been around for a while, which is always something that I look for. I don't want to necessarily always jump into a very new company because maybe it's still an idea, for example. So it's been around since 2010, founded by Jeremy Young, and the headquarters is here in Australia. Another tick in my box. So why I like the company is, our research indicates that AMS is a global leader in the monitoring recording space, and it's got the potential to really deliver those significant returns in the long run in the video digital age that we live in. In our view, AMS deserves and commands a higher EV sales multiple than what the market's currently offering. I say that because AMS has a high and stable gross margin business. They reported recently 48% in FY21. That's impressive numbers. And massive upside potential in their software sales. 100% gross margin. This is what this business is running. AMS has significant operating leverage to offer the market with leading products, and they've only really scratched the surface of penetrating the global markets in the US, Europe, and Asia. They've just also recently announced significant and meaningful partnerships with the global technology companies such as Apple and Adobe. So the company's well primed for growth and large product development. I also like the fact that Atomos plays in the gaming space. No pun intended here. We know that the gaming industry has the potential to have super significant returns in the next 5 to 10 years. AMS has the platform and the core technology already developed to layer across the gaming industry to produce more exceptional market-leading products. The latest numbers out there on streamers is it's sitting around 9.5 million as of Feb 2021. I think that trend is going to keep going up, right? Because we're not coming out of the pandemic world anytime soon, unfortunately. So assuming that Atomos just penetrates only 1% of this gaming market, they're going to hit revenues of like 600 million plus. And this is a huge addressable market because upside of 50% is what the company's forecasting in FY23. So that's just one gaming platform that we're looking at. We haven't even thought about, YouTube, Facebook, the list goes on. So assumptions that we see the company growing is really just based on one platform provider. So pretty conservative for AMS. Recently, the company reported in the midst of reporting season. Like I mentioned earlier, revenues were super impressive, up 77% year on year. Gross profit up 133%. 133%.
Love to see
don't
it.
You wish you? That's massive. That's year on year. Margins 50%. EBITDA. Love a profitable tech business. That's great. EBITDA of 8 million. Call me old fashioned, but I invest in profitable businesses. And the result was well ahead of expectations. And as we see every day, Felicity and I, when a company sets the bar and they beat on expectations, even if it's $1, they get rewarded massively in the market. So, you know, since they reported, they're up about, in the last 30 days, the share price has done a 30% rally or so. Love that. In terms of recommendations and long-term price targets, and when I say long-term, you got to think at least 12 months. That's how the analysts put the price target on there. It's Shaw and Partners is sitting at a $2 share price and the market consensus about $1.93. So we're talking significant upside on current levels. That's why, you know, again, I'm a user of the Atomos products. I think it's in the right sector. It's a really strong business with lots of growth legs, well run, great balance sheet.
Love it. Love it.
Nice. Well, I love that for two reasons. First of all, because it's that Peter Lynch style of investing, like invest in what you know, and it's a company that you've used their product, and that's where it really started. The other reason I love it is because Atomos was my stock of the year in 2020. Unfortunately, it fell 30%. It fell more than that during COVID and then never fully recovered. But I've just been having a look at its price chart. It's back to where it was when I picked it as my stock of the year in 2020. We'll keep holding. So now I think the growth is going to come.
Especially after that
I was just too early.
Exactly. Well, Candice, Felicity, it's been an absolute pleasure having you on. You've not only left us with a couple of questions to consider when it comes to thinking about wealth building that I think, you know, it's only going to be more interesting as you bring more of those questions to light over the course of this podcast, but two also really interesting stocks to think about as well. So for those listening through the Equity Mates community at the moment, Candice and Felicity will be doing a need to know episode where they're going to be deep diving on a strategy or a thematic that is important and something that they believe is really important to know. Then there's going to be an interview component or an episode where they'll chat with experts within their network to help unpack that need to know. And then obviously this order pad, which I am sure is going to be a smash hit. So plenty of content coming on Talk Money to Me, and we are super excited to now have this as part of the Equity Mates Media family. So girls, welcome, and we can't wait to see this play out.
Thank you.
We're excited to be here.
So there we have Candice and Felicity from Talk Money to Me. Really excited to get this show launched. Well, it actually has launched. First 3 episodes are currently live in your podcast app. Wherever you listen to podcasts, search Talk Money to Me, and you can listen to their first 3 episodes and subscribe because they're going to be sharing a lot of good content. I'm pretty pumped for this one. So Bryce, that brings us to the end. A bit of a segmented episode. We had a bit of a chat and we were joined by Speccy, and then we spoke to Felicity and Candice. Really the full range of the investing universe from the absolute punter that is Speccy Magee to some experts in their field in Felicity and Candice. So good episode, and speak to you again on Thursday.
Sounds good.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people today.